Hello everyone and welcome to today's in-depth learning video about the microfinance paradox of in navigating the over-indebtedness. Before I begin, let me come into a simple question. Is microfinance always a solution to poverty, or it can sometimes create a new financial problem? If we dive more into it, we can get to know that microfinance was introduced with a noble objective to provide small loans to low-income individuals who lack access to traditional banking. It aimed to promote self-employment, encourage entrepreneurship, reduce poverty, increase financial inclusion. However, over the years, the researchers and the policymakers have observed a paradox. While access to credit increased, so did borrower distress. This brings us to the core theme of today's topic: over-indebtedness in microfinance. So, let's begin with the fundamental concept of over-indebtedness. So let us first understand the meaning of over-indebtedness. Over-indebtedness occurs when a borrower takes multiple loans that exceed their repayment capacity, resulting in financial stress and reduced living standards. In microfinance context, a borrower is considered over-indebted when loan repayment affects the basic consumption. The borrower depends on new loans to repay and old loans. Financial resilience decreases significantly. According to the framework we used in our framework, the debt trap compromises of basic consumption, productive capacity, household stability. So let us imagine a situation when a rural consumer who has taken a loan of rupees 20,000 to repay the old loan. So when this type of situation occurs, like they have taken a loan first of all to start a small shop, then a medical emergency occurs, income drops. To repay the EMI, the borrower takes another loan, and this cycle repeats. Gradually the loan stops being a development tool and becomes a survival burden. So now let us examine the key symptoms of the over-indebtedness, the loan stacking, which the microfinance markets borrowers take loans from MFIs, NBFCs, digital lenders, and informal money lenders. The second symptom is asset stripping. It is a dangerous stage where borrowers sell productive assets such as livestock, sieving machine, and farming tools. And the third symptom is the most sacrifice essential, like consumption compression. It is mainly nutrition, education, and healthcare, just to meet the EMI payments. So now let us understand the debt spiral mechanism. Initial loan usually taken for productive purposes like small business, agriculture, and self-employment. Next stage is consumption shock. Illness, job loss reduces the borrower's income. Next is breach the loan. At the point of breaching the loan, to manage the liquidity gap, the borrower takes a second loan. The last stage is the saturation. Now multiple lenders are involved, income is stagnant, and repayment pressure increases. This sequence shows how productive loan can cascade into a chronic indebtedness when shocks occur and borrowers rely on credit instead of income and support. In this case of financial perspective, this is a classical case of unsustainable leverage at a household level. Now we move to the institutional side of the problem, the supply side drivers. When the multiple lenders target the same borrower segment, it leads to overlapping portfolios, excess credit exposure, increased repayment burden. Another critical issue is the information gap. The absence of real-time credit bureau data, lenders cannot track the total borrower's liability. Additionally, the incentive structure plays a major role. Field officers often have disbursement target and commission-based rewards. In such system, underwriting becomes lenient and credit risk assessment weakens. As highlighted in the content, growth-forced commercialization can undermine borrowers' welfare if not regulated properly. Now let us come to a point like analyze the borrower side also. Many microfinance borrowers have limited financial literacy and numeracy skill. They often misunderstand the loan structure, especially the difference between flat interest rate, reducing balance interest rate. These lead to underestimation of the true cost of credit. Behavioral economics also plays a crucial and important role in this. First is the present bias. Borrowers focus on the immediate need rather than the long-term repayment burden. Second is the salience of small EMIs. Small weekly EMIs appear affordable, but cumulative repayment becomes large. Third is the social enforcement and the joint liability groups. Peer pressure forces borrowers to take new loans and maintain group reputation and avoid social embarrassment. A recent critical development is in rise, and that is digital and frictionless credit. Traditional microfinance involved group meetings, verification checks, lending disciplines, but now we are having instant approvals, pre-approved order, minimal documentation. This ease on access increases impulsive borrowings. Aggressive marketing through SMS apps and online ads push borrowers towards repeated borrowing. While fintech improves accessibility, it also creates a new systematic risk in the financial inclusion ecosystem. So now let's discuss a case study based on 2010 Andhra Pradesh Microfinance Crisis. During the late 2000s, MFIs rapidly expanded in Andhra Pradesh with aggressive lending practices. These issues include multiple lending, opaque commission, coercive recovery practices, high repayment rates, and borrower suicide, and public protest and loan boycotts are the results of this. The government intervened with strict regulations leading to operational losses of MFIs, severe reputational damage, and industrial slowdown. The key lesson is clear: unchecked commercialization can destabilize both borrowers and the institutions. Another insightful example is SKS Microfinance. After its IPO, SKS prioritized rapid scaling and profit-driven expansion. This increased disbursement velocity and borrower exposures. As lending expanded faster, the income growth repayment stress increased. In contrast, Bangladesh adopted a coordinated NGO lending model, information sharing among lenders, better borrowing, monitoring, and controlled exposure limits. The comparison shows that institutional coordination and responsible lending frameworks are essential for sustainable microfinance system. Finally, let us discuss the solution of over-indebtedness. First, the credit bureaus, real-time reporting system like Equifax, CRIF, the high market help. This helps us to detect the multiple borrowing and improve risk assessment. Second comes the exposure rules. Policies like rule of two limit the number of active loans per borrower. Third, the responsible underwriting. Income to debt ratio check, transparent key fact statements of local languages, ethical recovery practices. Additionally, long-term solutions should include microinsurance, financial literacy program, and save-link product. Sustainable financial inclusion must focus on protection, measurement, and resilience building. So, toward the sustainable financial inclusion, we come to a point that protection or safeguard the household with exposure limits and fair recovery practices, measure and use the bureaus and analytics to detect early warning signals of distress, and to expand microinsurance, savings, and mandatory financial literacy for all resilience. So here we come to an end where we came to know about the overdebtedness is nothing but a psychological need of rural peoples. They want to borrow some money for their own need, and if some emergency occurs, they continue to take loan to repay the old loan, which leads to a debt trap. And this is where the rural people are also facing problems, and the financial institutions like MFIs who wanted to include them are also facing problems. Thank you.